Let's talk to Marc Ostwald. He is a strategist at ADMISI. Welcome, Marc. Right, let's talk Italy. Okay, lots of headlines over the years of how the nation is bust and the likes. Okay, you've got some thought-provoking slides.
Well, the theme for it in principle is, of course, we've got this announcement today that the Five-Star Movement and the Lega, or formerly known as the Lega Nord, the Northern League, are going to be forming a government. They are identified by the popular masses as both being anti-EU, populist, nationalist, and per se this would be the so-called first populist nationalist government within the EU that we've had for quite a long time. It would also be the 60-somethingth government that we've had in Italy since World War II, but it does mark something of a radical departure from the past, given that it wouldn't have any of the prior members of government involved. Eminently one would think that we would be running scared. But let's have a look at a couple of metrics and then talk about what challenges this new government, assuming it actually comes completely on board, because Italian politics is always extraordinarily fluid and the agreement today is not an agreement tomorrow and vice versa. But let's start with the market reaction to this announcement. We've seen a very modest rise in 10-year BTP yields, but in the greater scheme of things, if we look at it just in the context of this year, we're still in the middle of the range.
Yep.
So I would hardly call that carving out a big risk premium. And if one puts it in a longer term context in terms of the next chart, obviously
it's just a blip.
It's not even a blip, really. When one thinks of where we were in 2012 at the height of the Eurozone crisis, with 2-year yields around at 8% and 10-year yields close to 6%, as you can see, there is no great sign of angst here. Not really surprising. The ECB is still conducting its QE.
Yep.
Italy actually, in net terms, once you've taken out all the ECB purchases, has not actually had to sell any bonds to the market once you've taken out the ECB purchases for quite some time, basically ever since the ECB introduced QE. So when the ECB ends its QE, I suspect that's going to be rather more of a hurdle than the current concerns about the government. Right, let's move on to the stock market. Right, okay, well, absolutely no reaction there. But then I think we also need a little bit of context here. Yes, the Italian economy has been improving, and people are still looking around equity markets for better opportunities, given the yields that we've got in the Eurozone, including in Italy, and only excluding Greece, are so incredibly low and likely to remain low as long as the ECB remains dovish. So we seem to have a market which is oblivious to political risk, but then if one looks at the FTSE MIB in terms of a longer term consequences on the next chart, we actually see that we are basically half the level that we were back when we had.
Wow.
Well, more importantly, back in 2000, where we were close to 50,000. So in principle, and obviously one wants the constellation in the background in terms of a good performance of the economy and a government which people can trust, which is obviously a situation which we don't have at the moment, to be rather better to pick up that bargain which is staring one in the face when one thinks that pretty much every other market in the world is close to at the highs, as they say. Let's look at a couple of the economic indicators, just for our way of completing the picture. So this is Italian industrial production. No, it's not fantastic, but at 3.6%, that's not bad, particularly when one thinks that that zero line it wasn't breached for the whole period, basically between 2012 and 2016 in a meaningful way. So it is still trending higher, albeit there's a lot of catch-up to do with that really, really poor period of growth that we saw in Italy. Much the same applies when we look at the next picture, which is GDP. This is year on year. It's still trending higher. it's still got a lot of room to catch up. Again, it's much the same picture as we saw on the last one. So let's look at what these two parties have in common and what they don't have in common and what they proposed. Obviously, in terms of Italian manifestos for elections, basically one can always make the observation that generally whatever's in a manifesto never comes actually to pass. But there are certain areas which they are agreed on. The first one is pension reform. They want to roll back the 2011 pension reform, but the cost of rolling back the pension reform would be in the region of 20 billion euros. That would be less problematic if it weren't for the fact that even on the current budget, without them coming in, a caretaker government would have to be looking for 12.5 billion euros of savings if it's not to avoid what the previous governments have basically promised, which is if they miss on their budget, they will hike the sales tax in Italy automatically. So they've got to overcome the current budget problems. Then they've got to come up with these other ideas. There are a couple of other ideas which the two parties have bandied around, but they're certainly not, well, they're both diametrically opposed to each other. The Lega have proposed a 15% flat tax rate. That would cost probably something in the region of 15 to 20 billion, if not more. It's very difficult to actually estimate because when you say flat tax, what do you mean? What are you actually getting rid of? On the other side of the coin, and I should say the five-star movement are actually pretty much opposed to that idea. On the other side of the coin, the five-star movement wants to try and close the gap between the immensely poor south, which is its constituency, and what is a very, very rich north. The northern part of Italy, particularly the northern states around Milan, Turin, Venice, are as wealthy as Germany or France, Austria, but there is this enormous gap. And to plug that gap, the five-star movement have proposed introducing a universal basic income of 780 euros a month. That would cost in the region of 30 billion. So what we really want to know now is what exactly they are going to propose. And what we also need to really think about is we talk about this being an anti-EU, anti-Eurozone government. Both parties have in the past, though not in the run-up to this election, talked about having a referendum on leaving the euro, but they both basically walked away from that idea because basically it's not very popular. But we call these two parties anti-EU and anti-Eurozone, and obviously that presents enormous hurdles to the whole idea of Eurozone reforms. I'd probably counter with the fact that actually one of the most anti-Eurozone governments in the whole of Europe is the one which is installed in Berlin. It doesn't want to consider banking union without a much greater reduction in non-performing loans. It doesn't really want any form of risk sharing. So basically Germany is saying, well, we want the rest of the Eurozone and indeed the EU to be our fiefdom, which I can't think of anything which is more anti-EU and anti-Eurozone. But it does basically put pay to any ideas that Mr. Macron had of introducing reforms in any great hurry, and that's certainly something which has to be a concern if the slowdown that we've seen in the Eurozone in Q1 proves to be something more than just a function of strikes and bad weather. Then we are probably going to be testing the banking sector once again, and we're going to be testing government finances primarily because they're not in a particularly good state. And if the ECB really is going to end its QE program, then they're going to face the challenge that the ECB is no longer there as the buyer of last resort, even though it's going to be reinvesting. But they'll also have no other mechanisms which would strengthen the functioning of the Eurozone. So I think to isolate Italy as the villain in this piece is probably a little bit extreme. I think really, though, what it certainly does do is remind everybody that we have still a lot of hurdles to cross in the Eurozone, and if someone doesn't actually deal with it, then the Eurozone crisis probably will be back to haunt us.
Mark, on that thoughtful note, thank you very much indeed.